Hello again everyone, Ross McKinnon with you again, taking you through this reading on asset allocation. We're going to be talking about the basics of asset allocation and then building it up to something a little bit more technical as we go along. So let's get cracking. Here's our warm-up slide here. Don't be put off by this dull-sounding phrase at the bottom, investment governance. It's actually not as unimportant as it might sound. If you're an investor, you've trusted your life savings that you've sweated blood and tears for over your life, you're trusting that money to an investment firm, you want to be confident that they've got the professional people, those people have got the skills and they've got the processes and the third-party advisors to look after your money properly. So hopefully by the time we get to the end of this reading, you're going to agree with me that investment governance is not as dull as it sounds. It's actually going to be really exciting. Maybe that's stretching the point a little bit. But let's go back to some of the ideas that we talked about or that we would have come across at the very start of your level 3 syllabus, if you're going through it in order, which is your private wealth management and your institutional wealth management readings, whereby how does the investment firm and the client together come up with the decisions on what assets are going to be suitable for the client? Well, we start off with our client investment policy statement. Of course, fundamentally important for level 3, of course. You know you're going to be examined on that fairly thoroughly in the exam, and it comes back in here at asset allocation as well. So the client and the firm will have sat down, they'll together have thrashed out the client's objectives and constraints. Just as a little reminder for you what those are. So we've got our RR, TT, LLU. So risk and return objectives, and of course the constraints that the client's going to have in terms of achieving those objectives. We've got our time horizon, we've got taxes, we've got liquidity constraints, we've got legal, and of course unique, any other business, anything that doesn't fit in the other categories, we can pop in there. So the investment policy statement will set out those objectives and constraints. And then, of course, capital market expectations come in when we look at the different types of investments that are out there. What's the expected return that we're going to achieve? What's the risk? Traditionally measured by standard deviation, of course. And when we begin to bring assets together, equities, bonds, real estate, commodities, and all the others, really important consideration is how correlated they are together. If we want to get the benefits of diversification and we want efficient portfolio management, then ideally we don't have perfect positive correlation between all of those assets, which I'm sure you're aware of those concepts, but just a little reminder that they come in here again when we're talking about asset allocation. The combination of those two things, so we've got our capital market expectations, what we think about future risk and return for each asset class, alongside the constraints and objectives in the investment policy statement, we bring them together and we come up with our SAA. This is our strategic asset allocation. Probably the most important decision in the investment process is the strategic asset allocation, where we decide just how much of each or how much of the client's investments we put into each asset class. Ideally, the word strategic would imply long-term. This is based on long-term capital market expectations. So the strategic asset allocation we wouldn't expect to change very much or very frequently throughout the life of the investment. However, what happens if the investment manager suddenly thinks that perhaps short-term the strategic asset allocation is going to make us miss out on some juicy returns that are out there? Well, if that's the case, we can perhaps depart from the strategic asset allocation temporarily via a tactical asset allocation. So this is where the investment manager is going to try and add some value, try and squeeze some extra returns out of the investment based on more shorter term expectations about what's going to happen in capital markets. So this slide here is a really nice little overview about what the asset allocation process is all about. Now, as promised, what about this investment governance idea? Really important. Lots of different ways that an investment firm can govern and adequately control the performance of the funds that they're operating. But most of the models will have these 6 elements in common. So let's quickly run through them and make sure that we're happy with them. So long-term and short-term objectives. Establish what the objectives are for the investment. Now this is going to depend very much on the investor. So if we think about a pension fund versus an endowment versus an individual investor, they're going to have very different long and short-term objectives. Regardless of that, the investment firm has to make sure that they've got the client objectives uppermost in their mind when they're making investment decisions. Rights and responsibilities. This is really relating to the governance hierarchy. Is there a chief investment officer who makes strategic decisions and sets the strategic direction of the investment decision makers. Who are the people within the firm? Who are the people with appropriate skills and appropriate experience to really govern the investment making process? We've already covered in earlier readings and earlier study sessions the process of creating an investment policy statement, and a strategic asset allocation is going to be coming up later. So we've done IPS, we're not going to repeat it now, and then in future readings we've got a lot more detail on just how that strategic asset allocation comes about. We've got wonderful, exciting ideas like mean variance optimization, Black Litterman models and more, but we'll just leave that as a trailer for what's going to come a little bit later on. Clearly, we're not going to fire and forget with the strategic asset allocation. We're not going to set it all up and then never look at it. There has to be some sort of reporting framework. We need to be reviewing the performance of the investments regularly, making sure we're monitoring progress towards the goals and objectives. So what's our performance to date? How is our performance relative to those short and long-term goals that we talked about at the start of this list? What value added has the portfolio manager been able to create? So regular reporting. This does link to later areas of the Level 3 syllabus. We think about the GIPs and the reporting methods. Again, the Level 3 syllabus is very much more integrated perhaps than Levels 1 and 2. And we need to check independently, or as independently as we can, just how those governance processes and controls are operating within the firm. So that's a governance audit. We want to ensure the systems and controls are effective within the business. Okay, so to sum up, what is investment governance all about? Well, it clarifies the mission of the investment firm and the investment fund itself, creates a plan to achieve the client's short and long-term objectives, and reviews progress towards meeting them. Who are the lucky people that are trusted with this sort of thing? Well, we've got our investment committee. That's going to be towards the top end of the hierarchy of the firm. Of course, the investment staff themselves, they're the individual portfolio managers, and then third-party resources. These are advisors like actuaries if we're looking at pension fund liabilities. We've got legal support, all the different professional advisors that you'd expect a top-notch investment firm to be able to call on. Okay, so that's an introduction really to investment governance. And we'll move on to the next area of the reading right now.